we've got three speakers, as you can see, for this next session, each of whom has a sort of mini presentation to do. So we're going to start off with Peter Goodburn from WaveTrack International, who's going to kick us off with his first sort of presentation and thoughts on commodities. Obviously, as with every session today, we're really keen to hear as much from you and as many questions or anecdotes or points or disagreements that you want to make so that we can have a really productive exchange of thoughts. So please don't be shy, stick your hands up, shout out, do whatever. And equally for the panel, if you want to interject at any part, at any stage, then that would be very, very welcome, just to keep it as informal as possible. But Peter, if you're ready, you can take it away. Thank you so much, and thank you all for coming.
Great, thanks very much. Thanks, Daisy. There's a very interesting aspect that's kicked off the conference today because, of course, we've been hearing earlier this morning about emerging markets. And, of course, a lot of those countries which are in that bracket, of course, are producing commodities as well. And the one aspect which, of course, is also has been sort of discussed, and particularly in the last session, I think many of you have stayed over from the currencies just now, was that earlier this morning, the consensus was that actually the dollar would continue weakening, but actually in the currency session we just had, it seemed as if the analysts were talking about a dollar recovery this year, and I happen to agree with that, which I think is going to be sort of an underpinning sort of point to discuss exactly a pullback maybe in dollar-based commodities, because they're still so very much sensitive to the movements of the dollar as well. But before I get into specifics, just to put some outliers in, which I think's a rather bigger viewpoint from the commodity scene. Now, I do work with a deterministic process of price forecasting. So actually what we do for our clients is we attempt to actually look at major trends from developing disciplines. Actually, the actual discipline itself is better known as the Elliott wave principle, but it's actually much more scientific than that. It has been said that it's the discipline itself is very, very subjective, but over the last 25 years as a company we've developed ways to get around that a bit, bring in a lot more objectivity through geometric price ratio and proportion studies, and this tightens up the balance so that we can actually get some really good forecasts going. The one thing which I would say is that when people refer to the commodity super cycle, they tend to actually think about the commodity movement price advances from the lows in 1999-2000, when in fact it really began from the Great Depression lows in 1932. So that's how we view things. And if you take a database look at some commodities over a very long time period, and we've got some commodities going back to the Middle Ages, prices of silver from around 1250 onwards and things like that. One of the distinct points against the commodity sector is that most major commodities actually bottomed in 1932, and they were a lot lower at that low trough than they were several hundred years before. So that's a very good starting point when we go through a historical reference to how developing trends develop from that point. The other thing is that the super cycle effectively did end around 2006, 2007. Things like copper prices topped out in the super cycle in 2006, and a couple of others were a bit later. Oil, as you know, topped out, I think it was July 2008. But generally, the broader pattern sequence that develops from the Great Depression lows, they topped out at that point. And what you've seen since is a balancing phase for that very long-term trend. And that balancing phase we're still in the middle of. It's going to basically translate itself right through to the next decade. So we've got a long way to go yet. And that balancing phase is an archetype pattern in Elliott wave. But I've actually given it a term called the shock, pop, drop scenario, which means that you get an initial shock when the trend, the supercycle trend finished in 2006-8. So you get this big sweeping decline in prices, which is, of course, the first phase was the financial crisis sell-off. And then you get a recovery in the next phase. Now, what's very different about the Elliott process and what Elliott's original works, going back to 1930s and 40s, was that when a counter trend or a regression phase unfolds, you can often see a brief period where prices actually go above the previous peak of the supercycle peak. And that's what I believe that we're engaged in at the moment. We've been following this since 2010, early part of 2011. And so far, the price actions, including the 5-year drop from 2011 into the lows that we saw in 2016, have actually ticked all the right boxes. So we have a very high confidence factor and a very high conviction factor about what's developing. That means that this second phase of the shock pop drop is actually going to represent what we define as the inflation pop scenario. And that in itself has two phases, two big swings up. So the initial commodity recovery that you saw in 2009 when the central bank started to inflate things represented the big push up in things like copper, oil and so forth into the peak in early 2011. And then we had the 5-year regression phase. And now we're in the second phase of the inflation pop when what I call the grand resynchronization occurred in January, February 2016. And it was very evident and very clearly visible that low was going to come in, because if you put an analog of, say, copper prices or the MSCI Emerging Market Index alongside various other emerging market commodities, you can find that they all converged exactly at the right point, and they were very predictable. And that's why, since that low in 2016, we've seen very sharp price recoveries as this second phase of the inflation pop, and we've seen copper, oil from $26 going up to where we are today, and various other commodities all start to kick on. And I believe that in the broader sense, we're going to see that continue right through into the end of this decade and a bit into the next. So I think that cyclically, we're not looking at anything of a top until we get into the next decade, a year or two into the next decade. But this year, because we have cycles all telling us, short-term cycles that is, telling us that the dollar is going to bottom in March, April time, and then we're going to get, for the rest of the year, a very strong dollar, then we're going to see, we're definitely going to see some of these prices pull back downwards for the remainder of this year before they kick on and continue the second phase of that inflation pop later from 2019 onwards. So I think the biggest point for this year is the fact that we're going to get that regression phase. This, I should have shown you a couple of charts really, but this is the CRB from the Great Depression lows in 1932. You get a very archetypal 5 price swings up to finish the super cycle here at 615, and what I've drawn after that is really this regression phase, and we're in the inflation pop where we go into a brief new high. So this is the archetype of the shock pop drop, and we're sort of really we're in the middle of this phase coming up, and the resynchronization in 2016 occurred. If you take a look at the left briefly, you can see this is the 2016 low, and that's where we're about here in this little point here at the moment, and we're going to get that this year, this little pullback here. And for the US markets, it will probably be that. This is the US stock market. We're probably going to get that phase. Once that happens, you're going to get this big push up into the end of the decade, into the next one, and you're going to get that going on. So that's the broadest idea, and you can see how the grand resynchronization occurred here. So whilst the S&P was running up very strongly during that phase, different pattern, these were all in regression, Hang Seng, MSCI, Emerging Market, Singapore Straits. And probably something which tipped us off last year, I was here on the panel for commodities last year, but one of my biggest themes last year was the fact that the dollar was about to turn. We got to the 103 level on the dollar index, and it was very evident from this cycle, which is a 15.6-year cycle, peak to peak, trough to trough, that the dollar was about to turn. And this was the cornerstone of our forecast for the grand resynchronization in early 2016. And you can see the repetition is very clear. So when you've got that chart, it's a no-brainer that the dollar was going down last year, despite the consensus view at the time that it was going up. That was completely incorrect. This was turning out to be successful. And this is the dollar index, which is just a quick benchmark to what we can expect over the next month. So I think that we're pushing up a tiny, tiny bit from here when I've drawn this last week, but it's due to come down one more time. As soon as it breaks these lows, you start accumulation, and we'll start to get this for the remainder of the year. And this chart is copper prices. So you can see this is the bigger perspective, but there's a bit of regression here coming in on this cycle. But this is the big move up on copper prices that will continue after this regression phase this year. And you can see it sort of moving up into the next decade. And that's how it's going to look a bit further out. So you can see that we're looking at new record highs for copper prices when we look down. But this year, we're going to get a regression like this down on, this is 3-month LME copper prices, by the way. And gold, which I'm sure my colleagues will want to talk about a bit as well. I see a bit of a fake out, not a breakout, a sustainable breakout coming in the next month. And when this dollar index has one more drop and then starts to reverse, that dollar dip will probably send gold briefly above the 2016 highs. This is July 2016. And I think we'll get up to somewhere either between 14.16 and 43. And when the dollar turns, it's going to suddenly sweep all back inside the range. The bigger term trends are up, but that's going to be for this year, so that's the big event. And but looking ahead, one of the big performances is really on the precious metal miners. I've been very, very bullish for these since the lows were reached in the end of 2015, early 2016, and we identified this low within 20 cents 2 years ahead, and this regression phase is going on for something like Newmont Mining. But once gold drops down and the dollar recovers and this drops down, after that we go up into new record highs. And this is huge multiples. So when you saw gold, for example, in 2016 move up 30%, this went up 300%. So you can see that the outperformance is clearly in the mining stocks. And finally, crude. I've had 2 running scenarios for crude. One where we get up to about $79, $80, or a bit higher to 87, and then it drops. But actually, I think this is going to happen. I think we're going to get up to those sort of numbers. We'll go through a regression phase later this year. It's got a bit more to do yet to the upside, quite a bit more to do perhaps. But down the road, I think oil is going to break into new record highs, and that sort of very much comes up in our GDP analysis for the US GDP over the next several years, which I believe the GDP will do much more than everybody thinks. I think we're going to get up to 7% GDP growth during this phase. And the final slide is just the XLE energy spread SPDR, which I think is again going to show relative outperformance, but we're looking at new record highs. So, yeah, thanks.
Very interesting. Thank you so much. I invite Peter to sit down. Caroline, I think you're going to go next. And obviously, as I've said, I've got lots of questions for Peter, and I'm sure that everyone else in the room has too. So please don't be shy. If you want to, ask them now, that's absolutely fine. Or we'll let Caroline do her presentation and do questions.
Can I ask a question?
Yes, of course.
So, obviously I'll talk in a minute, but I think what's nice is to kind of combine, both fundamental and technical analysis when thinking about commodities. So my main question for Peter is, when I look at commodities, what I tend to do is to pick out the best available technique. So I suppose I'd ask Peter 2 questions. One is, does he accept that certain techniques work well for certain markets? And secondly, why would he argue that the Elliott wave technique is better than other technical analysis techniques? So MACD or Bollinger Bands or Ikimoku clouds, these kind of things are all quite useful, I think, for commodities. So I've got those 2 questions for you, Peter, if I may.
Do you want me to answer them now?
Why not? Why not, if Caroline doesn't mind?
Okay, you can just stand there. Sorry about that. Well, I think that when you say, one method over another, Elliott Wave is actually quite special, I have to say. When I first entered the commodity business back in the 70s and was trading then, I started to look at the dislocation between fundamental events, how they were coming through on the ticker tape, and how the prices responded. And I was actually a market maker, so I mean, we could see exactly the responses there. And over the course of my career, I've looked at pretty much everything you can imagine, and recognize that the markets are a fractally orientated and fractally structured progression. And whereas standard technical analysis tends to look at, I mean, if you know Edwards and McGee and things like that, you tend to get to a point where you see little patterns emerging as if they're sort of little wormholes, and then they disappear again, and you can't really get a grip of them. Elliott Wave is a seamless process of pattern progression, so that there's an ordered sequence, so that when one pattern finishes, it's going to naturally develop into the next one. So that's where the predictive value and the deterministic value is. So I don't feel that some of the other technical aspects that you were talking about, Dan, was they're what we call non-deterministic. In other words, a trend line or a moving average, you're only going to know about it after the event, whereas this is completely predictive, and that's a completely different story altogether. So when you start digging in beyond the so-called, I don't consider Elliott Wave to be actually a technical study. I see it as being much more scientific than that. When you start getting into chaos theory and you start looking at the fractal progress of deterministic systems, then you start to dig much deeper, and I think it's a much more underrated piece of science which is not really entered into the mainstream investment scene.
All right, now talking of chaos, I'm reminded that I've got about 22 minutes until lunch begins, and I do not want to stand between anybody and their lunch. So, Caroline, let's see your presentation.
I haven't got I'm just going to introduce the way we analyse commodities and tell you a bit about some of our key calls. I'm not sure if it is ironic, but we actually have quite a similar outlook as Peter, but for very different reasons. We look at commodities very much from a macroeconomic perspective. I'm lucky enough to work with 60 other economists who cover countries and regions. So if I need to talk about the US dollar, I can go to the US economist. If I need to talk about copper production, I can go to the Latin American economist. I feel as though there are three pillars to our analysis. There's obviously the supply and demand of each commodity, market balance, stocks, what's happening to them on an individual basis. Then there's the whole macroeconomic backdrop, what's happening to global growth, interest rates, currencies. And the third angle is we have to look at what's happening in markets as well. We have to look at futures curves, investor sentiment. And I feel those are the three main sort of factors I consider when we sit down to make a commodity price forecast. Of course, all these things are interconnected. And to kick off, I'm just going to do the sort of big picture macro. The blue line on this chart is our forecast of global growth, and the red line is the commodity prices. I think it's the GSCI. Yes, it is. We expect global growth to slow over the next 2 years. That's premised on slower growth in China this year and slower growth in the US in 2019. As the chart clearly shows, it's not very good news for commodity prices. The relationship is not perfect, but they do tend to at least go in the same direction. And our view on China, we've developed an in-house proxy for GDP growth because, as we all know, the official data are quite hard to believe at times. So there on the chart, the red line is the official GDP data, and the blue line is what's happening to our proxy. Our proxy looks at low-profile indicators, so things like internet shopping, freight. And according to this, China was already starting to slow in the fourth quarter of last year. So we've got growth slowing from well, it's about just over 5% there, and we expect an average of 4.5% on our measure of GDP growth this year. There's a lot of talk about what US monetary policy means for commodities, and most of it suggests that tightening is negative. And I just thought it'd be useful to have a snapshot of what commodity prices have actually done during periods of Fed tightening. And Fed tightening are the grey bars in this chart. The red line are commodity prices, the blue line interest rates. As you can see, almost always commodity prices continue to rise during periods of Fed tightening. This is completely understandable because the Fed is tightening because global growth and US growth are strong, which is also good for commodity prices. But to wrap up our global macro backdrop, the reason that we are negative on commodity prices, or particularly industrial commodity prices for this year, is not because of US monetary policy, but because we expect China's economy to be slowing. And just turning, I'm going to be very brief, to look at the individual commodities. We expect oil prices to fall back to 60 by the end of this year. And that's based on these columns here, which are showing that we think the market is going to move back into surplus. And that's because of surging US shale production. And we also think OPEC compliance could start to slip this year, given prices where they are. On the metals, perhaps similar to the China proxy we have for activity, we also have demand proxies for each individual commodity. The blue line there is our demand proxy, China's aluminium demand proxy, minus the supply picture and stocks. And as you can see, it's been advanced. It suggests that prices are set to fall. And just very finally on gold, the historic relationship with, as you probably all know, with the 10-year real yield has now broken down, and over the course of this year, we start to see gold falling back to where it historically should be against the 10-year real yield. That's a snapshot of our current forecasts, and I'm more than happy to chat about them when we have questions.
Caroline, thank you very much indeed. I'm going to hand straight over to Dan, I think, and then we can have as much time as possible for picking apart some of these predictions or numbers that we're looking at. Dan, the floor is yours.
Right, thank you very much, Daisy. So, I thought this was basically whenever I go and talk to people about commodities, I always think this is the point to start. Basically, what we're trying to show here is, one of the things I talk about a lot with clients is, what is actually driving the commodity price, because I think that's absolutely crucial. So what we've got here is, this is a kind of quite a long run chart going back to the early 90s, and we're not showing prices here, we're just literally showing the correlation between oil and these other kind of key variables. So what you can see here, for example, is you've got this, the correlation between, say, Brent and the equity markets is measured by the S&P 500. And you can see here that actually the correlations were pretty low in the kind of 90s and tended to kind of fluctuate around about zero. So that was a phase where actually, fundamentals were very much driving oil prices and commodities. And then you get this kind of similar relationship inverse against the DXY, the dollar index. So we had this phase here where fundamentals are very much in charge of commodities. But actually you can see here quite clearly visually, but you can do this statistically, there was this kind of clear break in terms of the drivers of commodity prices and oil round about this period here. So, as we went up here, we had a phase where oil prices and equities were correlated by at about 80%. And inverse, you see this kind of dollar weakness. So in other words, there's no point in being a fundamental analyst if oil prices are mainly driven by the wider liquidity environment, by equities and the dollar. So this was a real kind of shock, I think, for a lot of fundamental analysts. So, I started my career back here, where actually fundamentals worked very well. And then we went into this kind of new phase, really, which was driven by the emergence of China, as well as the emergence of, big commodity investors. And actually the dynamics of these markets changed quite dramatically. And then here we're now back to this phase where actually we've kind of generally drifted lower in terms of these correlations. We've kind of moved back to a phase where actually fundamentals is starting to become more important again. So to me, this is a kind of critical question to ask is, I would say from this, fundamentals are important, but actually through the kind of mid-noughties, if you like, actually they weren't that important. Whereas now we're swinging back into this kind of old world that I was used to when I started as a commodities analyst. So just to kind of not prove this point, but just kind of reinforce this point, if we go back here to the 90s, so this is mid-90s to 1999, this is a kind of typical pinch point kind of chart. So you've got here, oil inventories against the price, and you get this kind of fairly typical relationship, which is, of course, as you go lower in terms of inventory, prices tend to get bid up. So this is the kind of fundamental basis of any commodities analysis. And then in terms of R squared, you're around about 44%. I'm sure most people are familiar with this, but as you go up towards 1, it shows a strong correlation, and 0 means there's hardly any link between the two. So this was quite a nice kind of comfortable time if you're analysing commodities. Everything makes sense. You've got a good kind of toolkit in the box, if you like. And of course, don't forget that prices were, pretty low when I started my career back here. We're in kind of $10 to $20 range for oil. Of course, you've got to allow for inflation, but it was a much lower price, of course, than where we are today. But what happened next? That's the big question, isn't it? So, and this is where we went through in the noughties, just to kind of reinforce this point. So here we have this same kind of idea of a pinch point chart, but you can see there actually the correlations are absolutely terrible. The R squared is pretty much 0. In fact, you can see this kind of best fit trend line. Actually, you're moving in completely the wrong direction, which is inventories and prices rising both at the same time. So, in this phase, you almost might as well give up being a fundamental analyst, quite frankly, because, the correlation's just not there. So, at these kind of times, you should be more focused on those kind of big macro drivers, technical analysis, and all these things are very useful tools. So those are the main points I wanted to make today, which is that, when you think about commodities, what's driving the price, what's happening in terms of fundamentals, but also quite crucial, I think, is to understand actually whether that makes any difference to the price. So that was my 5 minutes, Daisy.
Thank you very much. Well, that's perfect. We've got 10 minutes before lunch to chew over some of those thoughts. Does anybody want to open up comments?
It's a question more aimed at Peter than the others, but your very last chart about oil, which I think showed oil going up to 3 times its current price. Now, I advise pension funds, and the pressure there is all for climate change reasons to not divest us, so certainly reduce your exposure to carbon. And I guess my question for you, they may be right, they may be wrong, but my question for you really is, do you pay any attention to that kind of secular input into the oil price at all, or do you just ignore it?
Did everybody hear, because we didn't have a microphone, did everybody hear the question? Okay, yeah, perfect. We do have a microphone, yeah, but I think we're all okay. Very, very good projection, sir.
Well, actually, I do pay attention to those things, and I think I'm very aware of the environment and the green policies that we should be nurturing our planet. So I'm very happy to see that some of the sovereign wealth funds are starting to withdraw from investment into the carbon sort of area. But when it comes to forecasting the price, I feel as if using those things to extrapolate a price projection, I probably did that through 4 or 5 lifetimes ago, and I've been reincarnated as a new person since, because it's futile to try and make long-range forecasts on that basis, because if you're going to non-linearly or linearly extrapolate these things, you'll never come up with a forecast like that. It's just too way off. I have to say that when we published some of our stock index forecasts back in 2004, we actually predicted the financial crisis within the Dow, I think 30 points within the top in October 07 and 60 points into the low in March 09, 4 years or 3.5 years ahead of the actual event. And it's a scary thing when you do price forecasting models using this tool, because it becomes a very humbling experience to be able to make forecasts that far in advance. And the only thing that prevents us from really benefiting from these types of things is our belief system, which has to be overcome if you're going to look at, say, projections of this intricate and specific amount and actually believe in it, to actually make use of it. In other words, if you were given an almanac from the year 2025 and could look back 10 years of commodity prices and saw it all, would you really believe in it? Perhaps you would, yeah. Back to the Future, the film. Would you really invest in some of that stuff? Or would you pick that up and say, well, this is someone's imagination. I don't even know whether this copy of the almanac is actually genuine or not. It's down to the belief system. But I can tell you that it does make, when you see long-range forecasting come to such an accurate point of view, to some extent it makes it irrelevant.
I'll allow Caroline and Dan to comment on that or anything else. But any further questions on anything that you've seen so far? There's a gentleman. Oh, perfect. So we have the gentleman at the back there with the white shirt on, yes, and then the chap at the front after him. Sir.
Yeah, so my question is more on the industrial metals. So Caroline pointed out that the majority...
I don't think that microphone's working. Is it switched on? Is it? Okay.
Okay. I'll just speak louder. So it's mainly driven by the slowdown in China's supply chain exists, but the other the meeting we talked about is a lot of synchronized growth in the global economy. Obviously, China is a big demand, sort of big demand. Is there any sort of offsetting, or you can say it's like the risk to your forecast? Is there any sort of upside risk to your forecast?
Caroline.
Yep. I suppose less of a slowdown in China. That would be an upside risk. We're very sceptical that, for example, the US is going to see strong growth in commodities demand, despite Mr. Trump's infrastructure plans, because certainly we don't see them getting through Congress. The Eurozone is growing strongly in our forecasts, but it's also the nature of the slowdown in China that bothers us. The fact that we're seeing credit being tightened, that the government is keen to cool the property sector. These are metals-intensive sort of areas, particularly metals intensive. So there may be other areas of China growing quite strongly, but the ones that we think will impact metals demand, the outlook is not good. I'm just thinking, do you want to add?
Yeah, sorry, if I could just add a few things. I mean, as Caroline said, I would completely agree with that. I think the main thing with China is to think about, I think we've already passed the point of maximum intensity of use within China. I think that's the key thing to understand. I mean, one of the kind of critical drivers in many ways is, of course, environmental, which is that China went through this massive kind of investment boom and, wasn't too worried about the environment. And, there's always been this talk about kind of, more efficient smelters, improving air quality, all these things, but they've been going on for a long time. And I think it's only in the past 2 or 3 years that we've started to see that taken very, very seriously, as we've had these significant smog problems around Beijing and the northeast. So for me, I think the phase of very intensive growth in terms of Chinese steel production and aluminium production is over, quite frankly. And I think going forward, we'd certainly argue that, we've seen peak steel, or we're very close to peak steel, because, the environment has become much more critical, I think, for people within China, and actually it's taken far more seriously than it was, a few years ago. So for me, that's pretty critical. And also, if we think about where the development is taking place, it's more about trying to, encourage the consumer and more kind of retail-driven growth rather than investment-led growth. So again, that's going to mean less need for steel, aluminium, and base metals more generally.
Very good. What a question at the front.
I've got two questions. The first of which is on this commodity slowdown related to China, and why haven't commodity prices fallen yet, given the fact that the evidence seems to be that the growth proxies, etc., have already fallen maybe 6 months ago. So why is it holding up? And the second question is, a very off-topic for commodities, but I noticed the Elliott Wave view had the stock prices going down 20%, I think you mentioned. So I'd love an elaboration on the stock price going down and when that starts.
Lovely. Well, so Karen, do you want to take the
Yep.
what's the lag?
China was growing very strongly last year. I mean, we're a bit long consensus to even suggest that it was starting to slow in the final quarter. We see the slowdown becoming more evident over the course of this year, and the sort of tighter monetary policy that we've seen over the last 18 months should start to be should translate into slower economic growth and activity this year rather than last year. Does that answer what you were saying about?
But why haven't commodities responded?
Oh, why haven't commodities responded? Because it's not completely evident. And, for example, China's imports of most metals are still growing strongly. We're in a lull at the moment with data because of the Chinese New Year holiday, so we're not sure what's been happening so far this year. And I just think there's too much optimism priced into commodity markets at the moment, and it's been a bit self-fulfilling. And that when it does become evident that growth isn't what it should be, then we could see quite a sharp correction.
Yeah, I mean, I think that's right. I mean, we've got to recognise that there's a lot of speculative froth in commodities at this point. If you look at oil or other commodities, you can look at the net spec positions, and they've got to extremely long levels. So, for me, I think what's happened is the people have assumed that the macro and commodity story are the same, whereas actually I'm not sure they are. So we're in this environment now where actually the macro story is still pretty robust. You look at PMIs or GDP or whatever, it all looks quite good. But actually, as Caroline's mentioned, if you look under the surface, some of the commodity indicators are they're much weaker. So we did see, copper imports falling back in January, for example. But actually, car sales as well, if you look at the seasonality, properly for car sales are also very weak in January. So I think it's right that there's this kind of emerging evidence that China's starting to slow down more significantly than we've accepted so far. But I think a lot of markets do get driven by this kind of big picture macro view of the world. And actually, I don't think they're taking enough account of those kind of micro drivers at this point.
Very interesting. And Peter, why are you so much more negative or than others?
I'm not sure I'm more negative than others. Perhaps I think in which you were saying about the stock market, I'm looking for a terminal high this year for the stock market. It's an interim high in the secular uptrend that began from 2009. And then I see a 20% drop, but I don't think that's going to come yet. Short term, I think we'll challenge back down to the lows that we saw at the beginning of February for some of the major indices. But this is not the type of decline of 20-25% that I'm looking for the major US indices. I think that will come later this year once we've made another new high. And then I think we get a bigger drawdown then. I think the emerging market scenario looks as if it's topping out. I was looking at Brazil this morning, and it looks to me as if the Brazilian index, the Bovespa, is topping out. And some of the mining stocks like Vale are ready to tilt over and move down. And I think there was quite a big drop yesterday, and I think that's the beginning of what I was looking for. So I think some of those, there's obviously going to be some sort of lag going on. But I think they will be synchronized generally at the end of the day. But I would expect to see US markets make a higher high and then have a much bigger drawdown. Only later do we get them moving up again later, once this correction's over, because the inflation pop means that we still, after this correction this year, we get 2019, 20, maybe 21, where the whole push comes up. And that's where I think the real bit of inflation comes in, not now. If you look at the break-even inflation tip yields, we've not really seen the big oomph that you would expect to ignite inflation. And besides that, when they bottomed on a secondary low in early 2016, the inflation tips have been moving up in a structural 5 price swing sequence, which is coming to an end actually right now. So they're going to have a regression period, which ties in with my esteemed colleagues' forecast for a pullback downwards in commodity prices. I think that will also occur. So I think this whipping up of inflation talk at the moment is going to subside. and that's going to be something which I think is going to coincide with inflation tips pulling back. So, yeah, it's I think there's going to be a little bit of dislocation going on between US stocks and the way that the emerging market scene is tilting over now, but they will reconcile itself later this year.
I know that Dan wants to come in. Just before he does, I'm just going to do a final shout out for any last questions, if anybody's got one there. So we'll take that final question, chap at the back. Dan, you wanted to comment on what Peter was saying.
Yeah, I mean, I just wanted to kind of say about, I know you mentioned about oil, but I think it's quite a good general talking point as well, because I actually feel quite strongly that technical analysis is very useful for kind of short and medium term thinking about commodities. But actually the longer term, I think it's really fundamentals to me that drive prices. So as you've spoken about, we have this kind of transition taking place within the energy space, and you can't ignore that from a price perspective, I think, which is that we're moving into this phase where there's less need for oil, there's more need for gas and kind of cleaner energy sources. So those kind of transitions will ultimately make a big difference in terms of growth rates for oil, and I think ultimately the long run prices are really driven by cost of production. So, you can't have a kind of technical divergence from the cost of production, I would argue, over, if you have a 5-year view on the price. For me, that's almost entirely driven by thinking about those fundamentals rather than technical analysis is the way I would see it.
Okay, lovely. Final question.
Question for Caroline and others. Why do you think the relationship between gold and the real yield is broken down?
Which I knew, actually. Well, certainly, there's a few things we've thought about to try and explain it. One of them is political risk associated with Donald Trump. Potentially is keeping gold higher than it would otherwise have been. Our markets people think that it may have something to do with the level of term premium. But I'm not sure that really applies to gold so much as the reason why the same thing happened with the dollar. So from my point of view, I would probably answer that with some political risk and safe haven demand propping up gold.
Do either of you have anything to add to that?
Yeah, I mean, I would say just very quickly, I think one of the challenges around gold is, I used to spend most of my time looking at the gold market actually in one of my previous roles, and I think what's very frustrating is that actually people get fixated on different things at different points of time. So at one point gold appears to track the dollar, at other points it appears to track real interest rates, and actually it's an incredibly fickle and unpredictable market in many ways. So I would tend to tell people that actually the dollar is often the key thing to kind of really watch, and actually there's obviously a link back into what real interest rates are doing as well, in the sense that they drive currency views, but for me the dollar is the kind of the underlying driver of that, if you like. So it's kind of a question of looking at the right thing at the right point in time is the way I would see it.
Lovely. Well, I think, given that it is definitely lunchtime, I'm going to draw a close to this session. Just leaves me to thank Caroline, Dan and Peter very, very much. We reconvene at 2 o'clock. It is back in the main auditorium for a keynote on MiFID II, and then more breakouts after that. But enjoy your lunch, and please show the panel your appreciation.